Hello, good morning. I see people are starting to join. We're going to get started around 12 or 12:01, so I appreciate you joining us for today's presentation. We have a good presentation for you today. Just like to give people some time to properly connect and get ready for the webinar. So again, we're going to get started around 12 or 12:01 at the latest. So I appreciate everybody's patience. All right, just another few moments. I see people are still trying to connect, so I want to again give them the time to properly connect and get ready for the presentation, but only a few more moments and we'll get started. All right, that should be plenty of time. Let's get started. So, hello everyone. My name is William Mucker. I am a client executive with Camaplan and would like to thank you all for joining us for today's webinar, Performing Due Diligence on a Fund Manager with Heather Dreves of Central Lending. As a quick note, please be aware that Heather will be answering questions at the end of the presentation. However, feel free to use the chat and/or Q&A function on your screen to pose your questions whenever they cross your mind. They will be saved and addressed once the presentation portion ends and the Q&A portion begins. Before we get started, we do have a brief disclosure to go through. Everything in today's presentation is strictly for educational purposes. Camaplan is a neutral third-party administrator of IRAs. We are not attorneys, CPAs, or financial advisors. If it comes to a time where you need advice in any one of those fields, we highly recommend you consult with your team of professionals. We are more than happy to be a part of the dialogue with your team of professionals to make sure the investment process is quick and seamless. We do not sell any investments at Camaplan, nor do we endorse any products. We will never call you about the next best investment opportunity. We believe that you should always do your own due diligence before investing your money, whether it be your retirement funds or otherwise. Once you have found the investment that is right for you, we will help you open your account, fund that account, and facilitate the transaction into that investment. Here is my contact information. If you or anyone that you know who you believe can benefit from the information have any questions about what is discussed in the presentation today and how it applies to self-direction, please do not hesitate to contact me. I would be more than happy to help. And without further ado, I'm going to pass the controls over to you, Heather.
Well, first, thank you for having me. I'm excited to be here. Going to talk about probably one of my favorite topics. And thank you for the disclosure. We are not financial advisors as well. We are not tax professionals, nor are we attorneys. So, one of the biggest things I can encourage people is if they have those types of questions to always contact their professional to discuss those things further. So thank you for sharing that disclosure. I'm going to share my screen here. So let's see. Does everybody see that okay?
Looks great to me.
All right. Well, thanks again for having me. My name's Heather Dreves. I'm the Chief Investment Officer with Central Lending. And like I said, the due diligence topic, I think is just so important, in this day and age, and, specifically people with self-directed IRA accounts. This is a perfect topic for a webinar with Camaplan, because the whole point of a self-directed IRA is that you can start now making decisions on how you want to invest your capital based upon, your risk tolerance, your investment goals. And so, I think the days of relying on a financial advisor and, other investment advisors is long gone, especially if you're adding these kind of investments to your portfolio. So I do have a passion for this, and I think there is a lot of information out there, this day and age on webinars, on the internet, but it's it's nice to have it organized in a way that, you can start to call companies like Central Lending and start to ask us questions, because, it is your responsibility to do your own due diligence. So again, thanks for having me. I've got a lot to cover. I don't want this to be a PowerPoint presentation where you guys are, dozing off and it's boring. I want this to be interactive. So as we go along, if you guys have questions or topics you want me to touch on, I encourage you to put those through the chat section of the webinar presentation, and I will do my best at the end to answer all of those. And then also, obviously, we can have an offline conversation if it's a little more in depth. So we're going to get started here. Little bit about myself. I have been in the fund management in the private money industry actually for over 20 years. I can't believe I'm that old. But I currently reside in the Pacific Northwest. I'm actually in a part of Idaho, which is northern Idaho, right next to Spokane, Washington, for any of you folks that are familiar with the area, very close to Montana. Have an amazing family, have been married almost 30 years and have two great kids. And we are active real estate investors as well as passive investors. And if I'm being transparent, I don't know that I would be doing those things if I hadn't got into the private money industry 20 years ago. It was very eye-opening, the opportunities that are out there for investors, whether you're active in buying real estate or whether you're looking for something more passive in the real estate market. There's opportunity for wealth creation. And so super thankful, one, that I was exposed to those types of opportunities. And also thankful that I get to work with my clients. I have clients that I've been doing deals with for 20 years, and I've seen how it's changed their lives, from a wealth creation to creating cash flow for them, once they've gotten to the place in their lives where they're, potentially hypothetically retired, or they've sold a business or something like that, and are in the place in their life where now they're trying to create cash flow for themselves. So just a lot of opportunity in these types of investment opportunities. I'm not here to tell you to leave your financial advisor. That's not the point. But the point is that there is opportunity to diversify your portfolios. There is opportunities out there for higher yields. I just moved my old 401k over that was earning a whopping 4.5%, and just funded a deal where I'm getting 12%. So there is that capacity to change your investment outcomes. And so, I think that the topic of due diligence is timely for people that are out there looking for other things and other options. So I'm pretty excited to be able to talk with you guys about this. Who is Central Lending? I think that's probably another important thing to just kind of cover. Central Lending is a private lender and also a fund manager. We're located out of Central Florida in a town actually called Lakeland, Florida, which is kind of between Tampa and Orlando. Great little town. We are what we would consider a private lender. So we lend money to active real estate investors. So these are people that are either buying real estate as an investment or selling or refinancing an investment property. And sometimes they'll come to us and refinance it because they're going to buy another property, or maybe they have a project that they need rehab funds for. So there's a lot of different scenarios for those types of loans. But ultimately, we're a private lender. So we act as a source of funding for these active real estate investors. So instead of them having to go to a bank who wants your firstborn child and a blood sample to give you a loan, we are less traditional. Obviously, we have an underwriting process, and we want to make sure that we're underwriting and closing good deals that, our borrowers can be successful with, meaning that they can make the payments and they can ultimately exit our loans. But we're also a little more creative in looking at deals, meaning we might look at a property to lend against, and it's a distressed property. The borrower has clearly defined what they're going to do to the property to add value to it, and we can see that outcome, and we can lend based upon that. There's a lot of caveats to that, and and safety measures that we put in place to make sure that we and our funds are well protected, in the event that a borrower should default on the loan. So there's more to it than that, but just at a high level, that's what being a private money lender is. And we are also a fund manager. And so we manage real estate funds that allow us to offer opportunities to our investors that are looking for something passive for their portfolio. And to be perfectly transparent, a lot of them use self-directed accounts. One of the nice things about funds, specifically ours, is sometimes you have the ability to reinvest your earnings. So you're always keeping your capital out there working. But we manage the day-to-day of the fund. We manage, the assets that go into the fund. We manage those from a servicing perspective once we lend the money out. So we are a debt fund, and we want to make sure borrowers are making their payments. They are exiting our loans by paying us back, because ours are short-term loans, 12 months. And, in the event that a borrower has a challenge or we have to foreclose, we also manage that side of it. So being a fund manager is a lot of things. It's not just working with the investors, getting them to invest money with us. It's managing the day-to-day and making sure that that fund is profitable and that our investors are getting the kinds of returns that they have expected. We are also an active real estate investor in the Florida market. That is where our founder, Andrew, kind of cut his teeth, was actively buying real estate and selling it. So we do still participate in the acquisition of properties and the sale of those properties, but only specifically in the Florida market. We do lend nationwide, but we really believe that investors should be investing in their backyards. It's easier to manage those types of projects. And so we like to practice what we preach. And that's what we're doing in the Florida market. And like I said, we have a brick and mortar office in Lakeland, Florida. It's a wonderful little town. I got to visit there recently and was pleasantly surprised. So if you're from that area, you probably already know that. But if you're not, might be an area that you may want to visit. And we always encourage our investors as well as our borrowers to come and see us in person if you're ever in that market. So we're going to talk a lot about due diligence. And, I talk to so many people and they really don't, it's kind of a buzzword out there. I should be doing due diligence, but I don't know that everybody really understands what that really means. So I thought it might be worth the time to just stop and talk about that. So due diligence basically is the process to scrutinize an investment before venturing into it. It's going to focus on the steps that an investor follows before entering an investment agreement. And I have to say, I've done this a long time. And I can't tell you how many people I talk to that are like, well, I didn't really ask all the questions, but then I asked it after I invested, and what I thought I was investing in isn't really what I invested in. And so it's so important to do this before you guys invest. You owe it to yourself. You guys have worked long and hard for the capital that you are looking at deploying. And so you are doing yourself a disservice not asking these types of questions. And it's just that important to be done prior to investing. And so, due diligence, again, the key to it is doing your due diligence before you make the investment, because many times once you make that investment, your capital's tied up and there's no, real estate investing passively is a great opportunity. You can get great returns, but it's not a real liquid investment, meaning you can invest and then call me up tomorrow and say, hey, I changed my mind. I want to get my money back. There's typically tie-up periods. So we're going to talk a little bit more about that, but just kind of wanted to clearly define what that means. But I think also more importantly, or first, before you start doing your due diligence on a fund manager similar to us, is I think you really need to sit down and ask yourself some questions, so that when you do start asking these questions of the operator or the manager, you can clearly define whether this is even going to fit your criteria. Because I talk to a lot of people also that say, well, I'm talking to 10 to 15 operators and they have what I call analysis paralysis. They can't ever make a decision. They didn't really clearly define what they were trying to accomplish. So I thought it was worth the time to, kind of just outline a few questions that you might want to sit down. And especially if you have a spouse or a partner, I get a lot of times, I'll get, the husband or the wife that calls me and they're ready to go and invest. And then a week later, I reach back out and find out that their spouse wasn't even on board or their partner. So I think, if you are in that situation where you're married or you have a partner, it's important to sit down and make sure that your goals and strategies are in alignment with one another. So I think, first, how much are you looking to invest is important. Most of these opportunities have minimum investments. So if you don't know how much you have available to deploy and you're looking at investment opportunities that are twice as much as what you have, it doesn't make a lot of sense to waste your time, right? So determine what that looks like. And it doesn't have to be all of your money, there's nothing wrong with dipping your toes in an investment and adding dollars down the road. And I actually encourage that. I will get people that'll call and say, I've got $500,000 in my self-directed IRA. I rolled over into a 401k and I'm ready to go. It's like, you don't have to deploy it all at once. I tell people, make an operator tell you what they do, tell you, what their expectations are, and make them prove themselves. So determine how much you're looking to invest. What kind of dollars are these is really important as well, because depending upon the investment and what your strategy is, for example, let's say you have self-directed dollars and you're trying to invest these, and you're looking at investing with a company that you're going to get monthly payments from every month. They don't give you the ability to reinvest. That might not align with how you're trying to deploy that capital, and it might not make sense. So, and that also can be determined by the amount of money you're looking to invest as well. If you have small dollars in your IRA, we all know that there's fees involved with having these accounts, right? There's transfer fees, there's annual fees. So you need to run the numbers. If you've got dollars under 50,000 and you're trying to deploy it into a 10% return, but you're going to get all these monies sent back, then you're going to have to redeploy it. That might not make sense. So determine what kind of dollars are these. Are these personal funds? Are these, self-directed dollars? I think it's important to determine that, because you should also be verbalizing that to the manager and the operator as well, so that they can give you the facts, right? Like if they have a fund that's what we call leverage and they're borrowing money against the fund, that might create somewhat of a headache. And Will can talk more about that with UBIT. But these are things you need to also be telling the operator or the manager that you're basically interviewing, right? And then determining how long your capital can be tied up. I mentioned a lot of these investment opportunities have tie-up periods. They're not super liquid. So, if you are having to take required minimum distributions, you need access to the capital to pay for your kids' college, and you're looking at investing in a syndication that ties it up for 5 years, that might not make sense. The other big thing that I don't think people think about as often as they should is, what is your strategy? Are you trying to create cash flow? Are you retired? You sold a business. Now you're wanting your money to work for you and continue to live your lifestyle? Or are you maybe younger or in a financial situation where you don't need the cash flow, and you are more hyper focused on a growth model where you can just keep your capital working, and ultimately possibly create some kind of a compounding effect. So it's important to identify that as well. I put in geographical locations. Some people are really hung up on assets that are only in their backyard, or, and that's probably more of a single asset investment. Maybe you're investing in an apartment complex through a syndication that's in Texas and you live in the state of Texas. So if that's something that's important to you, identify that. Asset class is another one. I believe in diversification, so I don't get as hung up on this. Either the deal makes sense and the numbers are there, and it doesn't. But to some people, they only want a certain type of asset class. Is that residential real estate? Is that commercial? Is it industrial? If that is a hot button for you, it's important to identify that as well. And then last but not least, honestly, I think you need your criteria for saying no to investments, and quick. If you're talking with an operator or a manager that's not transparent and willing to share with you, that's a huge red flag for me. And there's some other things too. Are they, auditing their fund by a third party? So you need to think about those things. And I think your criteria for saying no might be more clearly defined once we go through this presentation, but it's okay to say no. Like I said, this is your investment. These are your dollars that you are choosing to invest in. And it's okay if your strategies and your risk profile don't line up with that operator, to say no and to move on to the next one. So we're going to talk really kind of about 3 different areas to focus on: who the sponsor is, what the asset class is, and what investment monitoring looks like once you make the investment. I don't think enough people ask about that. And I get calls all the time. Well, I didn't ask, and they don't report very well. It's like, well, did you know that up front? So we're going to talk a little bit about that. These are just some really quick questions you could ask a sponsor. We're going to go into more detail with this, but if you just, and I'm happy to share this presentation with you guys. But if you want just 6, quick questions, you can use them all. You don't have to use any of them, whatever you like. But these are things that, I ask when I'm looking at investing in is, how long have they been in real estate? What's their story? Where did they come from? Like I mentioned, Andrew got started being an active real estate investor. I think that's important, to understand what their story is. What's their strategy? How do they source new investment opportunities? That's a big one in funds, especially debt funds, because the biggest concern you have with a debt fund is, okay, you raise all this capital, how are you going to get it out there working? That's the whole goal, is that money is deployed and it's working. So what does that sponsor, how do they source new opportunities? Are they marketing? Do they have, bird dogs out there? That's a great question to ask. What key markets do they operate in, and why do they operate in them? Like I mentioned, we buy properties in Florida because we're located in Florida, so it's okay to ask those things. What's their investment philosophy? How do you determine whether a deal is not worth doing? I can tell you at Central Lending, and there's no right or wrong answer to this. I think it's right or wrong if it matches up with your risk tolerance, right? Central Lending, we don't do risky deals. Now, it doesn't mean there's not risk in the type of debt we lend out. There's risk in any investment you guys make. But some lenders, debt funds, are more risk adverse than others, meaning maybe they have a staff of 200 people and they don't mind foreclosing on people. What is their model? Our model at Central Lending is we want to lend on good deals where borrowers can make their payments and they pay us off. We want the cash flow coming in. That's how our funds create returns for our investors. Like I said, there's no right or wrong, but at least understand, what their philosophy is on that. And then how do they generate value once you've made an investment? What do you get that ensures that your return of capital is a return on capital as well as a return of capital? For us, capital preservation is first and foremost. We love getting our passive investors the returns that they get, but at the end of the day, if we have this massive market shift, how are we aligned to get you 100% of your capital back? And that's what we consider capital preservation. And then who is the team? I think that's a really important one as well. So we'll go a little bit more into that. So sponsor background and track record. Who are the principals? What is their experience? I would love to say it's just me that makes our fund successful, or it's just Andrew, but the reality is you need a team and you don't want a single point of failure. If one of them, what's their backup plan? How do they replace someone that's a key player on that team in the event that something happens with them and they can't work, or, they decide to move on? I think that's really important, that there are team members as well as processes and procedures in place in the event that a key player is not in the game per se. Assess their qualifications, history, and industry reputation. I can speak to our team. We all bring something different to this. I have years of experience managing the day-to-day of a fund, working with investors. I've done everything from underwriting to servicing notes to originating notes. Andrew has a lot of the same qualifications, but what he also has is probably more experience with acquisition of real estate. I've fixed and flipped myself. It's not that glamorous. I didn't really like it. I told my husband, we're not Chip and Joanna. It was not that exciting. But Andrew has extensive experience with that. We also have a chief operating officer, and she's amazing. She's a process and procedure person. So, understanding who the team is, what their qualifications are, and their history is important. And then also, what's their track record? I talk to people all the time, and they're like, I was talking to this sponsor, I asked them their track record, they didn't want to share it. That would be a hard no for me. I would literally pass on that. And here's the other thing is, be mindful of sponsors that only share their track record that's great, right? If you're in real estate, there has been a project or a deal that you got in that didn't go as planned. And I think that's even more important. Like, how did they deal with that? When they had the non-performing asset. So you want the good, bad, and the ugly with someone's track record is my point. And that goes to the next point. Review past performance, including successful and unsuccessful investments. We're in a crazy time in this market. I think in the last 5 years, because the real estate market was so great, it made a lot of bad sponsors look really great. I would look and look for sponsors that have a track record longer than 5 years, because it was pretty easy to make a sponsor look great in the market, especially 2-3 years ago, right? What you want to see is, how did they make it through COVID? Were they around in 2007, 2008? Those are important questions to ask. And like I said, don't be afraid to ask that. I mean, this is your money that you're looking at investing. You should feel like they're being transparent and open enough to ask those types of questions. Investment strategy and objectives. What is the sponsor's investment philosophy and strategy? Understand what their approach to markets are, asset classes, risk management. Are the objectives clearly defined, and are they realistic? Do they align with your investment goals and your risk tolerance, right? I think that's important. And like I said, you have to, if you can answer those questions that I talked with you guys before we even started the due diligence topic, then you can clearly define and identify whether their goals, their strategies even align with what you are looking for. And you may find that you might adjust your strategies and objectives, but those are pretty specific, right? And there are plenty of good sponsors out there, and I do believe that you can find the right ones that will fit with what you're trying to accomplish and how risk tolerant you are. Understand the sponsor's financial health and their capital structure. So understanding simply how healthy is their financial situation, and what I mean by that is, do they have multiple streams of capital coming in, or do they rely on just one capital source, right? For example, central lending, we, like I mentioned, raise money into our fund. So our passive investors invest in our fund. We lend that money out. It's called debt. The fund makes money because these borrowers make their monthly payments, and then they pay us off at the end of the term of their loan. A lot of debt funds will also have institutional capital that will take out some of that debt, because let's say, for example, we have $2 million raised in our fund. If we only have 2 million and we don't have any takeout for that debt, we are at the mercy of those borrowers paying off. So we will fund up 2 million, that those assets sit there until they pay off, and then we can go fund more. The way that a debt fund becomes very profitable is they have takeout capital. So we fund up $2 million, and then we have institutional capital that buys that $2 million in paper off of us. We keep what's called an interest strip, which means we may charge the borrower 10%. Our institutional capital says, we're going to buy that $2 million in debt from you, and you only have to pay us 8%. The fund benefits because it keeps getting 2%. So it's a way that you can create that velocity of the capital, and you can fund more deals, ultimately making the fund more money. So it's important to understand, does a sponsor have those types of resources? Because if capital dries up from one-off investors, what is the backup plan? Which is to the point on the bottom right-hand corner, which says understanding the funding sources. Also asking, do they leverage their fund? And some people get freaked out by funds leveraging their fund. It really just means that a fund may go find capital from a traditional resource, and they can leverage the assets in the fund, again, creating more profit for the fund by being able to go originate or buy more assets. It's not a bad thing, but you need to understand if they utilize leverage, because if you are investing your self-directed IRA accounts, that can potentially create what they call UBIT tax. And Will can speak more specifically to that. He's the expert at it, but it's something to be mindful of. Some funds, like our funds, have two options. You can come in as an equity member, which ultimately potentially could create UBIT if you're using IRA funds, but we also have the option to come in as what we call a note holder. And that is a more fixed income approach, and that would not create UBIT. So again, when you're talking to these sponsors, I mentioned this before, be mindful and tell them, hey, I'm working with self-directed funds, or hey, I've got liquid funds as well, personal funds, just so that you understand any potential tax implications. And ask to review financial statements. We actually have our funds fully audited by a third-party auditing firm. And so we provide potential investors as well as our existing investors with the audited financials. We take that a step further because audited financials are only done on an annual basis. And we use a third party for that. But we also use a third party that does our financials for our funds every month, a company called Veravest. So those are things to also ask, like, are you guys using third party? You know, because it is important to have other sets of eyes on these books. And how often are these reviewed? You know, what does that look like? So again, audited financials as well as monthly financials done by a third party. It's not required. I think it's important. I've heard horror stories of clients of mine that have invested with other operators that didn't use third parties, that got into trouble, and they're now doing workouts to hopefully get their capital back. And I don't think that anybody goes into these deals looking to be a Ponzi scheme, but I think some operators just get into a little bit of trouble and then it snowballs, and a lot can happen in a year if you're only having financials done on an annual basis, right? 12 months, there's a lot that can happen. So again, it's not required, but for me, as far as the way that I invest my personal dollars, I want a third party looking at an operator's financials. So it's okay to ask those types of questions as well. Risk management and compliance is some other questions you guys should be asking. You know, assess their process for identifying, monitoring, and mitigating risks. Like I said, we're a debt fund, so the risk is a borrower might not make their payments. I actually just got off a phone call with my asset management team an hour before this webinar. We meet twice a week with our what we call servicing team. We go over our whole portfolio, who's paying, who's not paying, who's about to mature on their loan. We have very clearly defined policies and procedures, as well as we meet every morning for an hour with our processing team to go over the files. You know, these are, do we have title insurance? Is title clear? Are we in a first lien? Did we get an evaluation on the property? So make sure that the operator you're working with has these types of policies in place. The other one is the sponsor compliant with relevant regulations? Verify that they adhere to legal and regulatory requirements and the presence of any past violations or legal issues. You should be, I mean, we live in the world of the internet. You should be able to put an operator in Google and find out if they have any violations. Are they being compliant with the SEC? Now, we at Central Lending only work with accredited investors. So you actually do have to qualify as what would be considered an accredited investor. But we still have to file with the SEC. It's not as restrictive as if we were dealing with unaccredited investors, but there is still regulatory regulations that have to be done. So it's important to ask those questions. And I would search them. You can go to the Securities and Exchange website. You can put an operator in there. You can see if they have any violations or any open legal issues as well. This is a big one, performance metrics and reporting. what metrics does the operator use to measure performance? Like, what is successful for them? A lot of operators have what they call preferred rates of return, which is kind of a benchmark. Like, you guys get paid, basically a preferred rate means essentially that an investor gets paid first and then the operator shares in any upside. What does that look like? What is their target return? What has their target return been, and have they accomplished that in the past? So asking those types of questions, like, what does it look like to be successful for you guys? And then how transparent is the reporting process? And this is a big one. I've had so many clients that, and in full transparency, I encourage you guys to diversify your portfolios. I would never encourage someone to put all their capital with central lending or any other operator for that matter. And so I hear a lot about, hey, we like what you guys do. We didn't get this type of service and product from someone else, or even, constructive feedback like, hey, this operator does this. You guys might think about that. But one of the most common things I hear is that there is a disconnect with what an investor thought they were going to receive for reporting on their investment and what they're actually receiving. So it's important to have that conversation before you make an investment, because if you think you're going to be reported every month and this operator only reports once a quarter, you're going to be very disappointed. So what does that look like? How often do they report? How do they report? Do they send you an email with a report? Do you have an online portal where you can go and track your investment? Those are things to be asking ahead of time so that you're not disappointed. And like I said, if it doesn't meet your criteria, then it's easy for you to say, no, I'm going to pass on this because it doesn't meet your expectations. So again, those are conversations you guys need to have before you make an investment, not afterwards. Next is going to be fees and compensation. All of us operators, we are for-profit companies. We are not nonprofits, and that's okay. But I think as an investor, it's important for you guys to understand how we get paid, right? I mean, there is a cost to doing business at the end of the day. And I've had some investors say, I don't think you guys should get paid this. It's like, well, we have a staff. Do you want us to have a staff that can, follow processes and procedures and make sure that the assets are performing in your portfolio? Or do you just not want us to get paid and hope for the best? There is a cost to doing business, but it's important that an operator is open and transparent about that. I think where investors are disappointed is when there's hidden fees or they didn't ask ahead of time. So what fees are associated with the investment? There's always a management fee. I say that management fees keep the lights on. They pay the staff to manage the assets and the funds. There's not a ton of profit outside of management fees. Then there's what are called performance fees, or what I refer to as a preferred rate of return. So for example, with central lending, our funds have a management fee of 1%. And then there is what we call a preferred rate of return of 9%. So the next 9% goes to our investors. And then if we have returns above and beyond the 1% plus the 9%, so 10%, then that profit is split 75% to you guys as the investors and 25% to the fund operator or manager. And the way that model is structured is so that you get paid first. If we're not performing, we shouldn't be getting paid anything above and beyond that. So it's important to ask those questions, like, how do you get paid? And if they're not willing to share with you, then that's another criteria for saying no. Ensure that is the compensation structure aligned with your investors' interests. That's pretty easy to identify. But again, these are questions that are very okay to ask, and you guys should be asking that. And honestly, they should be telling you this without you even having to ask this. But again, transparency is so important. So just to kind of wrap up a few things, I really do believe in addressing these questions prior to making your investment. That way, if your expectations are one thing and they can't deliver on that, you can either adjust your expectations or you can make a decision that this is not the right investment for you. I think that a thorough due diligence process mitigates risks and helps ensure that you are aligned with their investment strategy as well. And honestly, I could talk about this for 2 hours. I want to be mindful of all of your guys' time. And there's a lot more to it, but I think from a high level, these are questions that you guys should ask. And I really kind of put this presentation together, based off of what I look for in a deal, right? And I think openness with an operator, transparency with an operator, understanding their history, where did they come from? Have they been through market downturns? To me is a big one. The guy that just started managing a fund 6 months ago, I would have some concerns with that. How successful are they going to be when there is headwind? Because there's always headwind and there's always risk in any kind of investment you guys do. But I kind of jokingly tell people these are self-directed IRA accounts, and the self-directed part of it is the key. You are making the decisions. You don't have a financial advisor or an investment advisor behind you most of the time helping you navigate this. So you guys have to take the responsibility on to ask these important and sometimes hard questions. But I think if you can do that and get to a place where you understand what you're trying to accomplish and what your criteria is, there's just so much opportunity out there. And especially for these, tax deferred, or even if you have Roth accounts, tax-free accounts. I mean, run the numbers on my 401k at 4%, 4.5. I think it was 4.3 when I moved it last week. And now I'm investing in a deal at 12%. I mean, it's life-changing. And especially if you are in kind of a growth mode with these types of accounts where you can keep that money rolling and keep it out there and keep it deployed all the time. So again, it's your responsibility to be a responsible investor. And again, I do think there's opportunity to get better yields than what's out in the traditional market, but it's going to take some ownership on your part, a little bit of time and effort. And once you start this due diligence process, you're gonna find, I almost have a checklist when I talk to these people, like, how long have you done this? What's your team look like? What's the exit? Because I think that's another thing, and I mentioned this at the very beginning of this presentation. What's your exit? Like, when do you need to be able to access this capital? And when you start asking all those questions of these operators, you can very quickly determine whether it's a good fit or it's just not a good fit for your investment strategy. So I empower you, ask the hard questions, and if you're not getting transparency from these operators, that is probably a red flag to move on to the next one. But again, there's lots of opportunities out there. I'm happy to ask questions. It looks like there might be one, but just on a side note, my contact information is up here. That QR code on there, I thought it might just be easy for you guys. You're welcome to follow that, put your contact info in, and I'm more than happy to jump on a phone call and discuss things further. Like I said, I could probably talk about this for 2 hours, but I know you guys are all busy professionals and have things going on in your lives. But I do want to encourage you. There's no obligation. I can share what I know. Again, I'm not a financial advisor, accountant, or an attorney, but I can share my experience and what I've learned over the 20 years in this industry. So thank you for having me. And hopefully I can connect with some of you and would love to discuss things further. Let's see here. There looks like there is one question so far. Mark, thank you. I have your contact info and I will reach out. My contact info also is up on the screen as well. So I encourage you to reach out if you're still on the presentation. If not, I will definitely reach out and get you more information. Any other questions do we have coming in, Will?
That's the only question or comment I see at the moment. So far, it's been a wonderful presentation, a lot of great information, very useful information. And I really love these due diligence webinars because I think it's the most useful information you could get from a webinar on these sort of platforms. So I really encourage people that are still in the audience now to ask questions. Something just came in from John. He's asking the minimum to invest.
Yeah, I think that's actually a great question. So the minimum to invest with us is $50,000. Now, I do tell people, and I get this a lot, like my husband and I both have IRA accounts. If you are a couple, spouse, partner, we will look at you as a household. And I mentioned that because sometimes I get people and they'll call and say, well, I've got 30 grand in my IRA and my wife's got 20, or I've got 30 in an IRA and 20 in personal funds. We can look at that as an overall $50,000. And so 50,000 is the minimum to invest with us.
Great. Thank you for that answer, Heather. Thanks for the great question, John. Looks like another question just came in. Tina asks, what are some sites we can use to check on a sponsor? I know of Google, of course, Glassdoor, LinkedIn, USJ Portal. Any other sources you recommend?
Yeah, I would definitely look at the Securities and Exchange Commission website, just to make sure that a sponsor is in good standing and is registered with the SEC. There's a lot of sponsors that fly under the radar. I've seen it, I've heard it. It doesn't mean that they always have to be, but that would be the first place I would go. We used to, well, so for fund management, we use a company called Verivest. They are a third party. They actually used to do due diligence on fund operators. And they now have a new website called FundSomm, SOMM. You might check with them. They will do third party due diligence on operators as well. And the other thing, and I didn't mention this, ask for referrals. I mean, there is nothing that says you can't ask an operator, hey, could you give me the name of a couple of your investors? And investors are really transparent. And to be honest, the ones I like to give people is I want them to tell potential clients the good, bad, and the ugly. It's not all roses and there is risk in it. But what I can tell you is investing in real estate, you have tangible assets back in your investment. It's not like a traditional stock market account. If that company goes out of business, you have nothing. But what you want to know is at the end of the day, if there's headwind, how is this operator going to handle this? And I think getting insight from past investors that are going to share the good and the bad is really important. So I would always ask for referrals as well. There's nothing that says that you can't do that.
Thank you. Thanks.
Um,
Thanks for
yeah.
the question, Tina. And it looks like another question just came in from Scott. He
Mhm.
asks, what kind of OIF assets do you generally invest in? Multi, storage, car wash, etc.?
Yep, I think that's a great question too, Scott. We are residential real estate. And I will tell you, I have had clients tell me, well, I invested in this fund and they do multifamily, they do commercial, they do self-storage, they do car washes, and they do residential. Everybody has an area of expertise, and I think the better operators and the colleagues in this industry that I know don't try to be everything for everybody. They focus on their core competency and what their niche is. Our niche is residential real estate up to 4 units. That's what we invest in. That's what we lend on. That is our bread and butter. So that's going to be always non-owner occupied. So just for clarification, we will not lend money to somebody that is living in the house. We want this to be investment properties only. It makes it easier to foreclose if you have to. You don't have all the legalities of owner occupancy and the fear of cram down loans by the government. So always non-owner occupied.
Thank you for the question, Scott. And rereading it, I noticed I misread it. It's not, he didn't say OIF assets, it's of assets, excuse me.
Oh,
um, I think either references or referrals works in that situation, Jim. Thank you. And Scott asked again, did you say up to 4 units?
up to 4 units, correct. So we'll do a quad property as well.
All right, perfect. Any other questions while we have Heather's time? If not, again, her contact information is up on the screen. For anybody who's also watching the recording of this in the future, please use it if you have any questions. And also always feel free to contact Camaplan if you have any IRA or self-direction related questions. We're always happy to answer those questions as well. For now, it looks like you've answered all the questions that came up, Heather. So I really appreciate you lending your time for today. That was a truly great information. And I want to thank you again and everybody who spent time with us today and anybody watching in the future. And I hope you and all of them have a great rest of your day.
Absolutely. Thanks for having me. And I'm looking forward to connecting with some of you guys.
Thank you. Take care.
All right. Take care.